Quick heads up guys, I ended up adding a few last minute examples onto the presentation that you won't see in the video, but that's okay because they aren't a big deal. These examples are for you in case you have a hard time visualizing certain examples. So, download the presentation and keep an eye out. Now onto the actual video itself. Alright, so welcome to another ICT Explained series video. In this video, I will be talking about daily bias and internal range liquidity to external range liquidity and vice versa. Now, yeah, I did change a few little things on my title because of the YouTube search algorithm seems to like it a little bit more. Anyways, I just wanted to briefly give you a little bit of context to this video. I know you guys don't like it when I go on my yapathons, but I think it's very, very important. And again, if you don't want to listen to what I have to say, I will leave a timestamp down below. But when it came to making this video, I already had a fairly brief understanding on daily bias, but definitely not to the level that I know now. I went to so much trouble trying to learn as much as I could for this series. I may or may not allegedly found some of your favorite mentors' leaked courses and may or may not have taken a look at them. And let me tell you guys, you have been ripped off if any of you have bought any of their courses. Only one of them I actually found a little bit more useful. Shout out to Dodgy, by the way. Totally unrelated. And I think that you are better off learning from their YouTube channels rather than buying any course. Now, I will always stand by a one-on-one, but when it comes to buying courses, definitely don't waste your time or money, okay? Most of this research was really based off of the ICT videos that I was able to find online. And I also looked into, again, may or may not have looked into some of these guys' courses to see if there was anything different. But I can promise you, you are definitely not missing out on anything. So, download the presentation. Don't forget to like, subscribe, and comment down below. And yeah, let's begin. Alright, so I need to make sure we are on the same page here and that you understand that this is not the holy grail of trading. And this is something I've said before. But the holy grail of trading is consistency, adaptability, and diversification of strategies. Why? Because if you can stay consistent on anything that you do and whatever strategy that you try to learn, plus being able to adapt it to any market condition, and being able to have different strategies to be applied on any market, you will always be more profitable than the guy that is out here buying courses. I need you guys to engrave that in your head. And if you have to, tattoo it on yourselves. I'm just joking. Don't do that. I'm pretty sure some dummy's gonna end up doing it though. If you do, send me a DM. I'd be very interested in seeing that. But don't do that. Anyways, so keep that in mind. Don't be foolish. Don't think that just by learning this, you'll automatically be profitable, because that's not what's going to take you from an unprofitable trader to a profitable trader. There's still a lot that you have to learn and go through. Okay. Now, the first bullet point here is subjectivity. Many of the concepts and strategies mentioned are subjective and open to interpretation. For example, determining external range liquidity to internal range liquidity. I'm just going to say ERL to IRL. Or daily bias often relies on individual analysis and your perception of the market conditions. So literally it's based off what you see. And I'll show you an example of that later on. But it's literally based off what you see and what you can perceive when looking at the charts. You might see something different from what I might see. All right. And 50% of the time, you won't always get it right. You're better off making your own system on daily bias, and if there is no bias, you can still scalp. So don't buy this lie that everybody says out here on these YouTube streets, talking about if you watch my video, you'll automatically become even more profitable. This will increase your win rate by 100% or whatever ridiculousness they come up with. I can promise you it will not. Okay, there is a lot to be understood about trading. Now, the next part is complexity. Trading involves dealing with uncertainty and complexity while everything other mentors and I provide give valuable insights and strategies. They do not offer a foolproof method to predict market movements with absolute certainty. Don't buy into the hype that someone can sell you a course that'll give you a foolproof method of trading, because it's all a lie. Next is market dynamics. The market is constantly moving, influenced by various factors such as economic data releases, geopolitical events, and investor sentiment, and a lot more. No single approach or strategy can guarantee success in all market conditions. It's all about adaptability and how you see it, okay? Next, it's not essential for scalping. That's right. I'm out here poking some serious stuff here. This is going to be very controversial. Daily bias isn't necessary for scalping, but can help hold runners for larger moves. Now, I will show you what I mean as we go down this video. But for everyone that has been told hundreds of times that you need a daily bias in order for you to scalp or for you to trade in general, you don't need it. I am telling you, you don't need to learn daily bias. So if this is why you're watching this video, because you thought that by learning daily bias, you're going to be able to finally scalp, let me tell you, you're wasting your time. I'd rather you watch this video to help you have a more understanding of how the market moves, as rather thinking it's this holy grail for scalping, okay? So bear that in mind. Next is psychological factors. Trading psychology plays a significant role in success. It really does, including managing emotions like fear and greed, maintaining discipline, and sticking to a trading plan. If anything, guys, this right here is probably the second thing close to a holy grail, okay? This right here. Man, oh man, how many people miss this. Lastly, continuous learning. Trading is a skill that requires continuous learning and adaptation to changing market conditions. While my material offers valuable insights, they represent just a fraction of the knowledge needed to navigate the complexities of the financial markets successfully. Daily bias isn't the only concept you need to know. Now, that doesn't mean that my content is not enough for you to become a successful trader. You can still be a successful trader with just the stuff that I've put out, but that's not everything there is to learn about the market. There's so much stuff that you guys can still learn to become even better and better and better, okay? Now that I've gone through all of this, let's begin with the good stuff. Now let's start with defining daily bias first. Understanding daily bias. Daily bias refers to the directional inclination or sentiment that traders have towards a particular market or asset for a given trading day. It could also be for a trading week or a trading month, but people typically use this for a trading day. It's like having a hunch or expectation about whether prices are more likely to go up, which would be a bullish bias, or down, in this case a bearish bias, during the day. Think of it as your gut feeling or intuition about which way the market might move based on various factors like recent price movements, economic news, market sentiment, etc. Now, why daily bias matters. Having a clear understanding of daily bias is essential for traders because it helps them make informed decisions about when to enter or exit trades, by having a sense of whether the market is leaning towards bullish or bearish behavior. Traders can align their trading strategies accordingly. Again, you don't actually need daily bias, but it is great to have. Now, how daily bias is determined. Daily bias is often determined by analyzing price action or order flow on higher time frames. For example, if prices have been consistently rising over the past few hours or days, traders might have a bullish bias for the day, anticipating further upward movement. Conversely, if prices have been falling, traders might have a bearish bias, expecting prices to continue downward. It gets a lot more technical than this. Promise you it does. Now, lastly, practice makes perfect. Learning to identify and interpret daily bias takes practice. Traders need to spend time observing market movements, testing different strategies, and honing their skills to become proficient at recognizing and acting on daily bias signals. By practicing daily bias analysis regularly, traders can develop a better understanding of market dynamics and improve their ability to make profitable trading decisions. Now on my Discord, I try to go over what my bias for the day usually is, or sometimes I give out a bias for the week. So if you want to see that, you can also join my Discord and take a look at it down below. Now, let's move on. Now we have trading instruments and timeframes. So from what I've been able to gather is that for indices and futures, daily bias seems to work best. Next would be Forex, then gold and oil, and lastly crypto. Now generally you can apply daily bias on anything that you want, but this is the order that I've seen that typically works best and is recommended, especially since ICT trades futures a lot. Now for timeframes. Daily bias, you use the monthly, and then you can use the weekly, and then the daily. And as for your entries, you can use the daily when using the monthly as your bias. Then you can use the 4 hour if you use the weekly as your bias, or you can use the 1 hour if you used the daily as your bias. Now here, if you're using the 4 hour, you can use the 15-minute. If you use the 1 hour, you can use the 5-minute. And if you use the 15-minute, you can use the 1 minute. Now that doesn't mean you have to use it in this specific order. This is just the order that is generally recommended. Now, believe it or not, but daily bias can be determined using the 4 hour and down. Yes, ladies and gentlemen, that's right. You don't need the daily time frame to determine your bias for the day, which is also suited for scalpers, whereas opposed to anything from the daily and up is for intraday / swing traders. Now, if you don't believe me that the daily bias does not need to be determined from the daily time frame, or the fact that you don't even need a daily bias can be said from the man himself, that boy Dodgy. Take a quick look.
Let me show you why bias doesn't really matter if you have good risk management and a good strategy. So I came in today, I was expecting us to hit this line because above this line, there's liquidity above and it would have been a 50% retracement. It was also a daily fair value gap, so if we hit it, I probably would have been bearish. Now you can see price clearly misses the black line and we just dump. But here's the thing, every single time we dumped, we never got a good long setup for me to go long, even though my bias is bullish. Because my strategy only depends on these bearish gaps breaking, that's all I wait for. And by the time we got all the way down here, at this point, I'm like, okay, maybe the bias is bearish. And fortunately, I did not take any loss. Finally tried one 30-second long setup right here where we closed above this gap and it just completely failed. It was about a 2-hour play and it just completely failed, and that was that. It wasn't a big stop loss. I got out very quickly and that was that. And then in my Discord, I said, I'm going heavy long if we inverse this. I still kind of held on to the idea that I want to long. And meanwhile, my Discord is making fun of me because they're like, Dodgy, the bias is bearish. We've already dumped 100 points and you didn't get a play and now you have a loss. But what do you know? We literally break this fair value gap and we actually got another fair value gap down here. And the win would have been bigger than the loss, and we finally ran all this LRLR and all these stop losses. And you can see I'm about $568 on the day and secured another payout.
Told you I wasn't lying. Now, institutions often base trades on monthly and weekly targets, indicating the importance of higher time frames in determining bias. This actually came from ICT himself. Now, the transition from objective to subjective analysis can occur rapidly, so be very cautious when analyzing the chart. And what I mean is sometimes you might find a PD array or something that looks like liquidity, but then it could look like something else on the higher time frame. You'll see what I mean. Lastly, the general consensus is to start with the higher time frame like weekly and daily to determine the overall bias, and then use the lower time frames like the 4 hour and 1 hour for more specific trading setups and entries. This approach allows for a comprehensive analysis of daily bias while considering both macro and micro perspectives in trading. This is just stuff that I've seen and I recommend you guys to try and test out when forming a daily bias. Now, important concepts refresher. I'm going to talk about some very important stuff that you guys should already know, but I'm going to give a quick refresher on them. You will see what I mean, but if you haven't already looked at my previous ICT videos before this, You really, really, really need to look at them, especially the one I already made on daily bias, which is a more simpler version of this, but it definitely builds on top of it. So please take a look at those videos beforehand, okay? So let's talk about liquidity. I consider liquidity to be anything, by the way. So premium discount arrays. According to the Inner Circle Trader ICT, a PD premium discount array is a checklist of different ICT tools arranged in a manner to execute a trade when at a premium or discounted area. Next is liquidity pools. Understanding and identifying liquidity pools can help traders anticipate potential price reactions when in a premium or discounted area, helping make informed trading decisions. And here are a few examples of liquidity pools. One could be highs and lows, which could be an external range liquidity, or considered that. Major swing highs and swing lows outside the structure range. Let me show you what I mean by that real quick. So really all external range liquidity is just these highs and these lows right here that are outside of the overall structure. This could be considered external range liquidity. This right here could be considered external range liquidity. This one right here, and this one right here, this one right here. I wouldn't consider anything here as external because it's still inside of this area, right? This whole vicinity right here, right? This whole area. So that's why I would consider just this as external, but it's up to you and how you see it. Now we have internal range liquidity, or IRL, which are the highs and lows inside the range, including minor swing highs and swing lows. I will give you a more detailed example later down these slides because it gets a little bit more complicated, at least for some people it might. Next is premium discount arrays. Entry models in premium or discounted arrays such as fair value gaps, order blocks, gaps, etc. All of these can be found in these premium/discount zones, and you can consider them as entry models depending on how you trade. Now, again, we'll go over some of these examples down the line, but you have to be pretty familiar with these things before continuing. Otherwise, you're gonna have a very, very hard time grasping this. Next is specific price levels, such as equal highs or equal lows, high of the day, low of the day, previous day high, previous day low, previous week high, previous week low, etc. I've included some more in the glossary section, but these are the most used, or at least the ones that I have seen to be more taught, okay? But you can use anything that you want, all right? It's up to you. It's whatever you feel more comfortable and whatever you have seen and been able to spot more easily, okay? Next on the list is fair value gaps. Now, if you don't know what a fair value gap is, just do a quick YouTube search and just take a look at whatever video you find. I'm pretty sure it's not that hard to understand. So real quick, fair value gaps represent an efficiency in price and can be utilized for entries. Expect fair value gaps to be retraced into if liquidity has been taken and displaced. And if you don't know what displacement is, it's really just momentum with a gap as well. Just do a quick Google search on that. It's not that hard to understand. Displaced above or below it, depending obviously on the trend that you're in. So if you're in a bullish trend and you see liquidity has been taken to the upside, you want it to displace above. And if you're in a downtrend, then obviously you want it to displace below. You can also expect fair value gaps to be inverted if liquidity has been taken but not displaced above or below that liquidity. Next, we have types of fair value gaps. So the normal ones are the bullish fair value gap, which is just called buy side imbalance, just a bunch of fancy naming here. And then bearish fair value gaps, known as SIBI, sell side imbalance, buy side inefficiency. I don't know why people use all this lingo for. It's just so unnecessary. Now, understanding fair value gap levels, you don't really need this, okay? But I'm gonna throw it in here for you guys because I know someone's gonna be curious about it. So 3 levels inside of fair value gaps. First is the fair value gap open, the midpoint, and the fill. And by open, all it is just the wick or the candle ends from the top to the bottom that haven't touched, okay? Now, guidelines when following the trend. Only use this if you're trading with the trend, especially if you're on the daily and up. I personally don't use this, but even Casper SMC uses this, so I thought, you know what, I'm just gonna throw it in there. So number one is valid move. If price moves into the fair value gap and fails to close beyond the midpoint, which is just the middle of that fair value gap, it is considered valid. An invalid move is if price closes above the midpoint, it is considered invalid. Wait for the next fair value gap for further confirmation. Third, it's the inversion. If price closes through the fair value gap, it indicates an inversion and possible change of trend. Now, I got a quick example here that I'm going to show you. Now, as you can see, price retraced into this fair value gap from here to here. That would be the openings. And there's all this unfilled space. So what does price do? Comes down, fills some of it, and then goes back up. And it even sort of taps into it down here. But continues up. And as you can see here, there was another fair value gap, but price was having a hard time closing or even touching the middle part. Finally, price touches and closes slightly above that middle line or that middle point of the gap. Just from that, people automatically would discount the fair value gap and will more than likely be inverted, which it did in this example. But I'm going to be honest, it doesn't always happen like that. I've seen fair value gaps get inverted and then quickly go back up in its original direction. Sometimes it's just tapping into this order block. Sometimes there's some more liquidity that it wants to grab, whatever the case may be. But I cherry picked this example just for you guys because I know you love it when I cherry pick examples. Next is this pro tip. If there are two fair value gaps on the same time frame, move up to the next time frame until they combine into one. You can look at this example. It's not that hard to understand. I'm not going to waste your time, okay? Next is gap types. Volume imbalance. That is one type of gap. Don't use this if you don't want to confuse yourself, but ensure understanding of it. Just quick YouTube search on what a volume imbalance is. It's not hard to understand. Again, you don't really need to use this for your trading, but it's always good to have that in the back of your head. Now, the other ones that are pretty important is the new day opening gap. Usage, use when obvious or when needing additional confluence due to uncertainty and bias. The function, it acts as a support/resistance and a magnet for price. Next is new week opening gap. Usage, utilize when obvious or when needing additional confluence due to uncertainty and bias. Function acts as support and resistance and a magnet to price as well. Now the drawing method. Both gaps, new day and new week, are drawn using session close to new session open, and here are the times. And my personal take is most of these rules apply best to the 4-hour and up, but you can always apply them to whatever time frame you want and whatever time frame you have personally seen best results. Again, it's all up to you. Now we have inverted fair value gaps. Oh yeah. So definition, expect fair value gap to be inverted if liquidity has been taken but not displaced above or below it. Now the guidelines are generally the same as the normal fair value gaps, but I have a few more here. Now if you don't know what a fair value gap is or an inverted fair value gap is, sorry. All it is just a fair value gap that wasn't respected and price essentially closed above or below it. And some people call it a fair value gap that was violated. I don't know why they would call it that, but that's just what some people refer it to as. Next is price inversion and target fair value gaps. Inversion between gaps. Price may inverse one gap to reach the next one above/below. Just depends on the trend you're in. Or price is looking for some type of liquidity to take and then continue in its original direction. Here's a quick example of that actually. So as you can see here, price inverted this bullish fair value gap, turning it into a bearish fair value gap, or at least temporarily. And then it inverted this other fair value gap down here. Why? Because it wanted to tap into this rejection block. Now, as I've always said, I consider almost anything liquidity. I consider a fair value gap a form of liquidity. I consider a rejection block a form of liquidity, because at the end of the day, all liquidity is just fuel for the market. So when it touched the rejection block, it started going back up. Now, I wasn't able to get it on the screenshot. I don't know why I didn't just screenshot the whole freaking thing, but I guess I also didn't want to confuse you. But yeah, price actually ended up going back up. So if you want to look it up, try finding it. You'll be all right though. This is just an example. You'll see more of this as you go trading, and if you want, find something similar on your screens or in trading view. I promise it's not going to be that hard to find something like this. This is how most supply and demand traders trade anyway. There's some gaps over here. There's an order block down here, right? Price taps into the fair value gap and then into the order block and then goes back up. You've seen this plenty of times, even in my own videos. Okay. Next, we have identifying target of fair value gap. So look for liquidity within the fair value gap, such as old ERL/IRL, order blocks, etc. There could be a lot of things inside that fair value gap. To determine which fair value gap price is more likely to retrace/invert into. You'll see an example of that as we go down further, but if you know what I'm talking about, you'll definitely have an easier time of finding where price or why price is moving towards a certain direction, or why it may invert a fair value gap permanently or even temporarily. Next is confirmation of direction change. If a fair value gap is inverted with 2 consecutive strong candles, it's likely not a false move. This suggests that price might actually start changing direction, indicating a potential reversal. Now, this is not 100%, but I've noticed this a lot, and it seems to do pretty well, especially if you start adding up a few more things to add more context to this. So I'm going to show you a quick example actually. So we were actually in an uptrend to begin with. So we had that bullish fair value gap. Here's the first bit of price tapping into it, and then we have another set of price that broke through it. And then here is actually the third. So you can either count this as 2 consecutive, or you can count this one as 2 consecutive. This could be the first candle, and then this could be the second candle. Either way, it broke through it, and as you can see, price broke this structure down here, causing it a change of character. But if you go over here on this example, you'll notice price barely broke through it, and after it barely broke through it, the next candle was actually a bearish candle, as you can see here. Then price started going back down. This is why I say I don't always consider a fair value gap to be invalidated just because it crosses over that 50% mark of it. Sometimes it does invalidate it, sometimes it doesn't, but you need to add more context to the market to sort of assure yourself of what you're thinking. All right. And again, these rules apply best to the 4-hour and up, but you can use them on whatever time frame you want. This is just my opinion. Now we are going to talk about internal range liquidity and external range liquidity. Again, download the presentation so that way you don't have to take notes, and that way you'll have everything that I'm seeing. All right, so let's begin. So the concept of IRL to ERL. All ERL and IRL is just another fancy way of saying liquidity, but pointing to more specific parts of it. So ERL, which is external range liquidity, which determine the next candle's likely direction based on the next support or resistance levels derived from major high and low swing points outside the structure range. Your interpretation of that is subjective. IRL, which is internal range liquidity, utilize highs and lows inside the range, using mainly minor swing highs and swing lows for liquidity points. Now, I typically use fractals as, my internal range liquidity. ERL to IRL relationship. There is a lot of subjectivity in ERL to IRL because analyzing ERL on one time frame might switch to IRL when moving up another time frame. So first, I'm going to show you an example of this little part right here. Now, as you can see, this is generally how it's taught, right? Everything inside the marked ranges are internal highs and lows, and everything outside is external major highs and lows. So external, 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 and external. Now inside here, these little fractals, I personally consider them as internal range liquidity. Some of it gets taken out, some of it doesn't. I don't know if you could see this part from here to here, right? That got taken out there. And then that got taken out from here. You can see that, whatever. Point is, you can see that price gets taken out as it's going. Sometimes it doesn't, sometimes it does. But these little highs, these little internal highs and lows is basically internal range liquidity. Now, I consider gaps from here to here, right? This would be a gap that apparently got taken out. That is also a form of internal range liquidity. An order block. This could have been an order block right here, right? I wish I could move this, but I can't. Let me see if I can do it again. Right, so this right here, that could have been considered an order block. That is also a form of internal range liquidity. Sometimes it's even considered external range liquidity. Okay, this right here, this order block right here, that could be considered internal range liquidity. This right here, this is actually considered external. Why? Because it's actually outside of the range and it's at a discount too. So this would also even be considered a PD array. And everything here is internal, again external. This right here could have been a form of internal, right? Because there's a gap from here to here. Pretty simple, pretty easy, but again, very subjective. Now let me show you from ICT himself why this truly is subjective depending on the way that you look at it.
Internal range liquidity. In the context from this high to this low, it's internal range liquidity. But from this low to this high, it's external range liquidity because it's piercing it down here. In other words, we created a range from this low to this high. So we expect this range to be given up and run the stops out here. Once that's done,
I'm telling you guys, I ain't lying. So, institutional trading approach. Institutions often base trades on monthly and weekly targets. Now, if you wanted to take a look of the rest of that video, I will link it down below, or you can take a look at it by clicking on here. Lastly, why is understanding this concept so important? The market consistently shows a tendency to fill and rebalance itself, especially with the filling of fair value gaps. The market usually tries to fill IRL, can be any type of liquidity in my opinion, first, then ERL. Again, can be any type of liquidity. But for now, if you want just to keep it easy, we'll just say internal liquidity could be just fair value gaps and external liquidity could be those major highs and lows, whatever. And the interchanging pattern continues throughout the market. The moment you guys realize that all the market does is rebalance itself, you can really quick base off the strategy just off of that, because now you know, okay, the market is usually going to do one of these two things: fill itself and then go back in its direction. Sometimes it will consolidate, but even then it's still filling itself. It's doing those two functions mainly: fills itself and then rebalance itself. You can simply trade off of gaps if you want to. It's really that simple. Now this is how I see IRL to ERL and ERL to IRL. So let's say you're in an uptrend. You're going up, you have some external range liquidity, goes down and touches on the IRL, which can be any type of liquidity. Again, that's just my opinion. And as you can see, creates liquidity as it's going up, then gets taken on retracement, then goes back up. So same thing here. Takes out some of that IRL, goes up, takes out ERL, and as it's taking it up, you got some IRL being created, goes back down, touches it, goes back up, takes it out. Same thing here, creates liquidity as it's going down, then gets taken on retracement, then goes back down. We're going down, and as we're going down, there's some IRL being created, as well as some ERL, goes up, takes some of it out, goes down, takes ERL out, goes back up, takes some IRL out, goes back down, takes some ERL out. It's really that simple. This happens on literally every time frame. Open up a chart, check it out, see what you can spot. But I'm telling you, it's really that simple. So let's move on. Okay, so determining daily bias. Here's when I put everything together from liquidity or ERL to IRL or IRL to ERL. We're going to put it all together and start talking about forming our daily bias. So let's begin. These are just my steps to how I approach daily bias. I will go through each one shortly after, but if you want, you can just use this for yourself when you're looking at determining daily bias. So number one, start mapping out structure on the higher time frame of your choosing and determine if the market is currently bullish or bearish. Why? Because if bullish, then price might focus on targeting the previous day's high. But if bearish, then price might focus on targeting the previous day's low. Second, start making out areas of liquidity on the chart on the higher time frame that have been taken and still need to be taken. For example, you can mark the next support or resistance levels derived from a high or low swing point that hasn't been and needs to be taken. So that could be a form of ERL, right? External range liquidity. Those major highs and lows, mark those out. Mark the ones that have already been taken and mark out the ones that still need to be. Number three, ask yourself, has price taken IRL or ERL in order to determine where price might be headed next? Remember to keep making out areas of liquidity as price moves. Lastly, repeat all these steps. You will repeat all these steps. You'll see what I mean by repeating them, but you can repeat them. Now, pro tip, if your bias isn't clear enough, you can check the Dixie. Now, here's the thing. I personally don't check the Dixie or the dollar index. I don't do it. There's a lot of people that do use it, but I personally have never found it useful. So, I mean, it's up to you. If you want, you can look at a YouTube video on it. That'll probably give you a better explanation. I'm not going to do that because since I don't really use it, I don't want to mislead you guys. So I'm pretty sure you can find a bunch of other people that could teach it a lot better than what I would have. But yeah, you can use the dollar index as part of your daily bias if it isn't clear enough. But it's up to you. So for step one, start mapping out structure on the higher time frame of your choosing and determine if the market is currently bullish or bearish. I recommend to be as detailed as possible, especially when you're starting off, just to make sure you're kind of getting the ropes of this. So at first we were bullish, right, as you can see when I was marking out this ERL, and now we are bearish since we had failed breakup structures, especially one that didn't get taken out up here, and there seems to be a possible change of character. That is why I say mark out everything step by step, be as detailed as possible just to get an overall better picture. Step 2, start marking out areas of liquidity on the higher time frame that have been taken out and still need to be taken. So staying on that same time frame, you are now going to mark out those areas of liquidity. So as you can see, I marked out that daily fair value gap. This ERL for me is liquidity, but as you can see, anything could be considered ERL or IRL. And then I also marked out this daily fair value gap, this other little fair value gap down here, and even this demand zone. Pretty simple, pretty easy. And as you can see, yeah, there's another tiny little fair value gap down here, which is very important, so we can't miss that. Now, step 3, ask yourself, has price taken IRL or ERL to determine where price might be headed next? Remember to keep marking out liquidity areas as price moves. So as you can see, I fast forwarded 3 candles. As you can see, price had initially taken part of that fair value gap, and then what did it do? Ended up getting some bullish momentum. Price actually touched this little fair value gap. I don't know if you can see it. Let me try zooming in for you. Now, as you can see, price somewhat touched this little fair value gap and then quickly rejected. But what happened? It did not even take these lows. So It still closed bullish, but inside of that candle. So what does that give me? It tells me that either price is going to give me some bullish momentum, and it may or may not close above that fair value gap. Fast forward to the next day, which is this candle. What happened? We had some strong bullish momentum, took out the previous day's high, and then went back down, took out the previous day's low, but closed bearish, and it actually respected this fair value gap because the body did not close over it. In other words, it didn't violate it. Such a weird thing to say. So what can we determine off of that? It means that the next day we should also have some bearish momentum, which we did. Although price did not reach the previous day's high, it did take out those previous days low and closed bearish. Pretty easy, pretty simple. And as you can see, it touched that fair value gap, telling me that it somewhat respected it. But since now the overall time frame or the overall market sentiment is still bearish, I am assuming that the next day will continue to have some more bearish momentum. Finally, step 4, repeat all steps. So as you can see here, we did have that bearish momentum, broke through that fair value gap, then touched into that order block. Then we fast forward the next day, price took out the previous day's low, still in that order block. And now what do we have? Another bearish fair value gap. Next day, we had some price action going on here, right? We had some bullish activity. As you can already see, price started consolidating with these two candles, and they closed bullish and closed above our zone, which means that we are more than likely going to start heading back up, which we did. It inverted that bearish fair value gap, turning it into a bullish fair value gap. What happened? The next day, price took out that previous day's high and respected that inverted fair value gap, causing price to go up. And as you can see, pretty obvious, right? And again, if you haven't seen my first daily bias video, you need to check it out because it builds up on top of it. But yeah, as you can see, we had that bullish price action, price taking out some previous day's highs, some previous day's lows. In this case, it didn't take out neither, but still closed bullish, indicating that we were still going to have some kind of bearish price action, but overall the sentiment is now bullish. So as you can see, took out the previous day's lows on these two candles and the previous day's highs. But since it closed inside of this bullish candle, it said, hey, we'll still have some bullish momentum to get through with, which we did. And as you can see, it didn't even take out the previous day low on this candle or the previous day high. And then the next day we had some more bullish momentum, finally breaking out and going back up. Now don't worry guys, I will still show you another example on the charts. So let's hop on and let's go through it all over again. Okay, so step number 1, start mapping out structure, right? Okay, so let's map out this part right here. Let's see here, that could be a good bit. Say this, right? This could count. This could also count. Let's see, maybe this right here. All right, and then actually, I think you could say price actually caused a change of character down here, and price failed to go back up and create structure around here. That's just my opinion. So as you can see guys, I'm not even sure if it's this side that I should mark out or if it's even this side as my failed breakup structure, but I am 90% sure that that's what it is. It's all subjective. Okay, it's all subjective. So what is my bias now? Well, we were bullish, but now we are clearly going bearish. All right, because again, we had that change of character here. Price failed to close above this gap here, right? So it respected it, telling me that, hey, we're gonna still continue down bearish. All right, so now we're gonna zoom in here and start just looking at some recent price action and any other possible areas it might target, right? IRL here. All right. Looks like we have a fair value gap here that it might invert. Looks like we have a really strong bullish fair value gap here. So considering that we are bearish, I have a good feeling that this might just be an inverted fair value gap real soon. So we'll just see what happens. So now that we have marked out everything, we can now assume that we're good to let price play out. So again, this is on the daily. What did price do? Went back into internal range liquidity. All right, perfect. Now we just gotta wait to see what price decides to do next. Our assumption, since price already went inside, it's gonna go outside. All right, so price respected it, stood out, right? Didn't close above it. So what can we expect for it to do now? Probably target previous day's low. It already took out the previous day high right here. So we should definitely be good to go. And it even took out this high right here, some liquidity right here. Let's see what it's gonna do. Bam, went outside to this external range liquidity. External range, right, because it's outside of the candle or the daily candle, and it even took out the previous day's low here. Okay, so now let's see what price decides to do next. Okay, so it went inside. Why did it do that? It's probably going to create some kind of fair value gap, which it did, or who knows, maybe on the lower time frame, right? Maybe there's something on the lower time frame that it wanted to go inside to. As a matter of fact, let's drop down to, let's just say the 12-hour just for fun. And let's see here. You know what? We'll go back here and let me just go back. Let's find something inside that says, hey, oh, look at that. There was already a fair value gap on the inside. So we play it, and what it do, it touched it, filled it in, or filled some of it in. And now we have another fair value gap here on our higher time frame. And we can keep letting it play, right? Let's see here. Price touches in, rejects it, closes bearish inside, means we're gonna start having more than likely some bearish momentum. So pretty simple, right? Following the steps. If we were doing step 2, we were marking out areas of liquidity on the higher time frame that have been taken and still need to be taken. Obviously we did that already, right? This area was already taken. This area still needed to be taken. And then ask yourself if price has taken IRL or ERL in order to determine where price might be headed next, which we did. And we still kept adjusting and adding our liquidity areas, right? So as you can see, we saw that price did take out liquidity here, the previous day's high, and it tapped into that fair value gap, rejected, closed inside of this candle, meaning that we might still have some more bearish momentum going to our ERL. What did price do? Took out previous day's ERL for a lot of people. Now it should start looking for some kind of internal resting liquidity, which it actually did if we were to have gone in the lower time frame. But in this case, let's not go down the lower time frame. Let's just stay here on the daily. It decided to go for some more ERL. All right, let's see what price does next. Stays inside but closed bearish. Okay, you know what I'm gonna do? I'm gonna make it easier for us. I'm gonna mark this out. All right, and then the same thing here, here to here. All right, let's see what price does. Took out both sides and closed below this candle. So what it do, took out some, if you wanted to be subjective, you could say internal, because these could also be considered some kind of fractal high. But it took out these highs right here out of the overall range. So you could say this could be part of the overall range, right? So this is just ERL. Actually, I think I have something that tells me, yep, ERL here and ERL here. Right, so since this is ERL and ERL, this could also be considered some internal range liquidity. That's what I'm saying, guys. It's so subjective. It's really also just subjective. Just know that it's targeting some kind of liquidity. Same thing that we're gonna do here. We just know that price is going to go either inside or outside the target liquidity. We just know that it's going to do one or the other. All right, perfect. As you can see, price didn't even go up or below, but closed bullish. Why? Probably because of this, right? Maybe this is an order block for it. Maybe it's considering that an order block for it. Next, bam, bullish momentum. Why? It probably did take this as some kind of order block. We'll just say it's some kind of demand zone, right? Maybe it's like, oh, look, demand zone. This could be a pre-DRA, right? It was in a discount. Price tapped into it, went back up. Who knows? Maybe the price is going for this inverted fair value gap, or to invert this fair value gap. We don't know. Price taps into it, touches it, right? Still respects it. Still on that bearish fair value gap. Price is still pretty bullish, so who knows? Maybe price might still go up to target that external range liquidity. All right, next day, as you can see, took out some previous day's lows, didn't close above this fair value gap, still respecting it. We might be going down again. Oh no. So this is why I say trading is subjective, guys, because it's somewhat inverted it. We still need to wait for another candle confirmation. But as you can see, just because we call something internal range liquidity or external range liquidity, we automatically think that price is going to do what we want. This is why it's important to read price action and why not everything is 100% sure. Now let's see what price does. Okay, so it clearly inverted that fair value gap. Maybe it's targeting some of this trendline liquidity right here. We don't know yet. What it did was take out some of that liquidity that was up here, right? Took out some of that trendline liquidity. And then finally, we have that strong bearish momentum. Price did not take out any of these lows. We have some bullish momentum. Why? Because there's still this order block here. But since, again, the overall sentiment is bearish, price finally broke through it and giving us some more bearish momentum. Now, who knows? It might tap back into this fair value gap, this bearish value gap, actually. But as you can see, market is always doing one thing or the other, going up, going down, doing its thing, whatever the case may be. So I hope you guys learned something in this section of the whole course. Obviously, not everything is as easy as follows. Sometimes you won't always find it easy to have a bias. Sometimes you won't have a bias. Don't get discouraged, okay? Just don't get discouraged. It's a lot, I know, but there is still a lot of people that are struggling just like you. And again, you'll never get this 100%. Even I don't always get it 100%, but that's okay. It's all about having a adaptability to the market, being able to have your psychology locked down, having multiple strategies. I mean, just basically everything that I talked about in the beginning. So let's move on to the last few sections of this video. So now I will begin to talk about trading with daily bias and just my personal takes on it. Okay, so just pay very close attention, look at the presentation, download it, keep it with you. You'll find it very, very useful. All right, so for my personal takes, part 1, using the daily chart is considered if within a weekly or daily fair value gap or order block. If so, then look for reactions in such scenarios. Again, this is just my take. Now, when inside a fair value gap on the 4-hour or below, lower time frames can help indicate whether it will be respected or not. For example, let's say you're inside a 1-hour bearish fair value gap and you drop down to the 5-minute, right? Just drop down to the 5-minute and 1 or 2 bullish fair value gaps appear. The market then violates those fair value gaps, turning them into an inverted fair value gap. Then that means the higher time frame is likely to remain bearish, right? So again, we were on the 1-hour, we had a bearish fair value gap on the 1-hour, dropped onto the 5-minute time frame. You notice that a couple of fair value gaps appear, but those fair value gaps weren't respected. They ended up being bearish fair value gaps or turn into bearish fair value gaps, indicating that, hey, this 1-hour fair value gap might actually hold, right? So for example, 2, on the 1-minute time frame, inside a 1-hour bearish fair value gap, if the lower time frame is clearly bullish and price respects the bullish order blocks and fair value gaps, it suggests that the hourly bearish fair value gap may not be respected and the market may move towards the highs. Pretty easy, pretty simple. Next, trading ideas. It's just my personal take on how you can trade with daily bias. Something else you can do is begin by assessing monthly or weekly charts to determine bullish or bearish sentiment. Then move to lower time frames such as daily, 4 hour, 1 hour, or 15 minute, whatever you want, to identify whether buying or selling opportunities aligned with your monthly or weekly bias. Meaning, if you're going to enter on a lower time frame for a buy and your monthly says you're bullish, then that's a higher probability trade. Example, begin by observing the transition from IRL to ERL or vice versa on the higher time frame, like the weekly. Once determined, shift focus to the lower time frame, like the 4 hour, to look for setups that align with the weekly. So again, if you're a higher time frame, like for instance that weekly time frame that we're talking about happens to be bullish, and then you go down to the 4 hour to look for your setups, and you find that you have a buy setup going on for you, well, guess what? Two things are both going in the direction you want it. It's probably a high probability trade, and you should take it. Right? Pretty easy, pretty simple. Next, for no bias traders, if you don't have a daily bias, then you scalp using this method. You don't have to restrict yourself to this one thing, but this is something I recommend to try. First, look for obvious fair value gaps or order blocks on a daily/weekly time frame. If none, then look for obvious singular fair value gaps or inversions on the 4 hour or 1 hour, and look for reactions off of either one. To ensure an optimal entry, make sure it's all done from a premium or discounted area. Just use your fib for that, right? If it's above the 50%, you short. If it's below, you buy. Simple. Stay on the lower time frames and scalp using the 15-minute or 5-minute. I personally love the 15-minute time frame, and wait for equal highs/equal low formations. And this all depends on the trend that you're in, if you're bullish or bearish, to get taken. Or you can trade off of inverted fair value gaps or whatever kind of trading style you like, then dropping to the 1 minute for entries. Lastly, don't go for a big risk to reward or RR just to be safe. Lastly, trading against price. In general, moves that are counter trend to the draw on liquidity, magnet on price, are permissible, but may require more experience to navigate effectively. So if you're going to counter trend trade, you can, but that's a little risky, but you can still do it. SMT divergence. SMT divergences are also a great tool for confirming your bias, but it is not necessary for trading. Now, if you want to learn more about that or see someone talk about it that's more experienced on this specific topic, then you can just click here and it will take you to that video. Lastly, these are just some useful questions to ask yourself on any time frame when you're trying to figure out what the next day would be or what it could possibly be, right? So the first thing is, what is the overall trend? Is price in a PD array and what type? Has price shown reaction to the PD array? If so, what type? What I mean by that is, let's say you're in a bearish fair value gap and price moves into it. Did price react to it negatively? Like did the bullish candle reject off of it quickly? Did that candle turn bearish or close bearish? Right? What happened? And next is, did price close bullish or bearish? That's just asking you if the candle itself closed bullish or bearish. Did price close inside or outside of the previous candle? So all you have to do is look at the candle and say, hey, this price or this candle closed bullish, but it closed inside of a bearish candle, right? And you can put this on the spreadsheet and add points to it. For bullish, you add 1, or for bearish, you add 1. And then afterwards, you can add them up and say, okay, overall, everything's pointing towards bearish. So that means that I should have a bearish sentiment for the next day. It's that easy. You can try that if you want. It's up to you. But again, these are all just my personal takes. This is just stuff I've seen and stuff I've learned along the way, and stuff that I learned from ICT, other traders. And I wouldn't put it in this presentation if it wasn't useful in any way, shape, or form. Again, you can take it however you want it and make your own trading plan out of it. Who knows, you might actually make more money trading this way. So let's move on. Remember to keep it simple. You can trade market maker models, Judas swings, turtle soups, or whatever you want. And this is actually a trading plan from the man Pickle himself. This is a great strategy. I actually tested it out. It's pretty darn good, so give it a shot. I'm pretty sure you won't be disappointed. And if you just want to see how he trades with IRL and ERL, you can definitely take a look at this video. It's a lot more simplified than what I've given you. The point of my video is to give you all the stuff everybody talks about into one specific video that you can look back and refer to. But if you don't care or you think it's too much, you can always take a look at this man's video. He's an amazing trader. I love the way he trades. Highly recommend it. And he even explains his trading plan that I've got here. And if you want to learn how he trades news, since I don't really like news events, I've actually started taking a look at it and I think it makes sense. So if you want to learn how to trade with news using IRL to ERL, definitely take a look at this video. So real quick, I have put a trading example on how I would trade ERL to IRL and IRL to ERL. And you can go through it through the PDF. I saved it just for you guys. You can all take a look at it. I will break it down for you on the charts, just so maybe it'll be a little more easier and more fluid for you guys. Okay, so let's hop on there. As you can see, I marked out my areas, my failed breakup structure, my possible changes of character, and as you can see, price breaking structure through here. Although I really wouldn't consider this much of a breakup structure, but you'll see why in a minute. Now, some people might discount this as a valid PD array. I personally think it's still valid. Reason being is because if I go on the 12-hour, price didn't actually close to the 50%. So as you can see, price tapped into it and rejected off of it pretty strongly. Real quick, I'm going to break down everything that's going on here. As you can see, I have it from here to here, my fib level. There is a form of external range liquidity inside my fair value gap. So we have ERL and IRL together. You can see that I marked out this and this. These are all previous days lows. Now I can mark even more out if I wanted to, but I don't want to confuse you guys. So I dropped down to the 15-minute. And now that I'm in my 15-minute, we can actually wait for price to give me something, some kind of momentum, something that says, hey, I'm ready to go down. We wait. I'll just fast forward it for you guys. Okay, so it is 7:15. Really at 7 is my kill zone hour. So what I usually do is I will also mark out some more. Actually, let me turn that off. Some more stuff that I think is important. I don't know why I have this out. Okay, so as you can see, I marked out this fair value gap. Waited for some displacement. Waited for my kill zone hours. And I set my limit order here. I put my stop loss just above this high, or you could have put it on this high or this high, how you feel more comfortable. But since I already know that my overall bias is bearish, I should be good to target the rest of this liquidity here, or here, going for a 7 to 3. So we're just gonna let price do its thing. We're gonna let it tags me in. We let price play out. Right, does its thing. Now you can manage risk. Me personally, I don't really like taking anything off unless I absolutely see a reason for it. But what I could have done is maybe after this set of liquidity, I could have taken a little bit of my position off there, but I don't like to move my stop loss. Why? Because it's already tight enough as it is. Personally, that's how I see it. Now, let's say if price breaks down through this area, as you can see, it's already having a hard time breaking past through it. If it breaks through it, then I would probably think about moving my stop loss, but not until then. So price is playing. I'm holding this trade for a few days. It's going down. Bam. Finally, take profit gets hit. 7 to 3. Nice. Big risk to reward. Now I'm going to show you guys another example on how you guys can use IRL to ERL for trading. All right, so on this next example, we are on the Swiss franc, and this is the 4 hour. Now, as you can see, I marked out this fair value gap because there's a gap going from here all the way to up here. And as you can see, price is having a hard time trying to reject from it, but it's also having a hard time making new highs, or at least strong ones, as you can see, right? It's having a hard time. Here I have my demand zone. So what can I expect price to do? I can expect price to go back into this IRL. These things are confusing sometimes. So we're going to let either price play out, or you can scalp your way up to IRL. Now that's going to be a little bit more tricky, but we're going to give it a shot. We're going to wait for our kill zones. And another thing is, if price already reacts off of it by the time it gets to my kill zone, then we're just going to start looking for shorts. All right, so we're just going to wait. Sorry about that, guys. I had to fast forward for you. Now, as you can see, price already reached this bearish fair value gap. Now, it hasn't completely inversed it. And I want to see some strong momentum before it does. I want to see maybe like a break and a retest of it. If not, I'm still bearish. Okay, so as you can see here, we have some momentum. I have some bearish momentum here and a little bit of a bearish fair value up here to here. I can hardly see it though. So let me just wait and see for price to tell me, hey, I'm ready to go bearish. It actually tapped into it right here. I don't know if you guys can see it right there, right? Price taps into it, rejects off of it. So you could either enter there, or you could enter as soon as it breaks a fractal low, which I want to wait because it's pretty risky. So what do we have here? Looks like we finally got that break. No, it's just a wick. Okay, now we got that break. So now we have that break of that fractal low. What I'm going to do, put my stop there and put it just above this high right here. Now, what do I want to target? Let me just go for a fixed. Let's just go for a fixed 1 to 5 and then see where that takes us. I'm expecting this to go to external at some point. Now, I'm actually just trading this as it goes, okay? Because I want to show you that you will have some losers no matter what. But my bias is still bearish. So we're going to keep letting price play out. What do we have here? Failed highs, right? Failed highs. Some more displacement towards the downside. Plus fractal lows getting broken right here. We had a fair value gap right here, but it's outside of my kill zone hours. And you can still trade it outside your kill zone hours. It's up to you. I might enter depending on what I see. Okay, yeah, I'm definitely gonna enter. This is strong bearish for bearish momentum here, especially on this time frame. And I'm gonna put it up here. If price takes out this high, it's probably gonna go up. But I'm going to be safe about it, and I'm actually going to target the middle of this fair value. So let's just let price play out, do its thing. Okay, it's going down. All right, so TP hit. Now another thing that you guys could do is, if you want, you can target this set of liquidity right here. I don't know if you can see that. This right here, or this right here. Or if you just want to say, you know what, I'm going to go for a 2 risk to reward just to end it. Okay, try that, see what you get. I'm gonna wait, I'm gonna let price play out. We got some news coming in for the next day. We'll let it do its thing. I'll fast forward it for you guys. Okay, so now that I fast forwarded, as you can see, TP was hit. Final TP was hit. So what can we learn from this? You don't always need to trade during kill zone hours. It's okay to take an extra trade as long as you're still during that New York session with all that momentum. Kill zone hours really, again, just give you a little bit more of an extra confluence and help push price towards the direction that you want it. But you don't have to be restricted to just kill zone hours. But again, they're a great confluence, especially if you want to stay strict to your rules. Now, me, I personally don't mind holding my trades for a day or 2 or 3, as long as I know what I'm doing and it makes sense to me. I think this should end this part of the video. And I believe I'd have one more thing to cover with you guys. So just remember, I do have that glossary here. It's only got like maybe 2 or 3 things. So you can always check it out, you know, in case you have to reference something real fast, or if you wanted to find out, you know, what the rest of those liquidity pools are, or some PD arrays. Definitely give it a look. And finally, thank you guys so much for sticking to the end of this video. I know it was a lot of information. Believe me, I'm exhausted trying to get through it, but I hope you guys learned something from it. I hope that it helps you out, maybe gives you an extra edge, gives you the thing that you were missing, or maybe just clarifies some doubts that you might have had. Whatever the case may be, I hope that it was of use to you. And obviously, before I go, I got to give you guys my quick Bible verse here, which is from Matthew 6:33. But seek first the kingdom of God and his righteousness, and all these things will be provided for you. I'm pretty sure I gave this out on my previous video, but honestly, I'm going to leave it on here because it's really profound. A lot of times we focus so much on what we've got going on and our own problems and our own ambitions, but we got to give God his place, which is the number one spot, and he will give us the things that we need, the things that we want. He will know what we need and what we don't need. All right. So again, don't forget to look for him, seek him. He has a plan for everyone. And if the market is against you, just remember God isn't. So with that being said, guys, I'll see you all in the next one. Peace.